Hey doing guys, back with another audio blog, and this one is called An Open Letter to Aspiring Traders, What You're Getting Into, and How to Prevail. Okay, so let's jump right in. Trading, you found it, you fell in love with it, and now what? So the beginning stages of this game are absolutely brutal. You're going to be horrible at it, you're going to feel stupid, you're going to put in endless hours of work, and you're still going to lose money and make the same mistakes over and over and over again. In just about anything else, when you're learning, if you put in lots of hard work, you'll get better at said task at a rate of time relative to the amount of work you put in, right? The harder you work, the faster you'll get better. However, trading is not one of those things. So don't burn yourself out at the beginning of your trading journey, staying up until 3 a.m. every night, thinking the answer to all your problems is I just need to study harder, or it's in some book or some DVD or online. It's typically that's not going to be the answer. The answer is just screen time and experience. There are ups and downs in the beginning, way more downs than ups. There will be moments of clarity early on when you're going to feel like you've turned the corner and figured it out. Let me tell you, you haven't. So don't get cocky and try and rush the process. You'll be knocked down to your knees more times than you'll care to count with that attitude. So always remain humble. That's first and foremost the most important thing. And 90% of you will quit. And believe me, you'll be very, very tempted to be one of those people. But don't. If you're lucky enough to make it, this is literally a dream job. You have no boss, no hours, no agenda, no dress code, no meetings, no difficult coworkers, no rush hour traffic, and endless motivation. At a normal salary job, no matter how hard you work, your paycheck at the end of the week is still the same, right? How is that supposed to keep you motivated and hungry to improve yourself? In our profession as traders, once you're consistent and making money, the harder you work, the more your paycheck is. Talk about a reason to get up in the morning. It's complete and utter freedom in every sense of the word. You can work from anywhere. You can travel the world. All you need is a laptop and a Wi-Fi connection. Really, the entire world is your office. That's simplified, of course, but that's the gist of it. Do you want that? Of course you want that. But there's some very important things that you need to understand up front. All right, so let's talk about what day trading is for the independent retail trader like you and I. Day trading is a very, very difficult uphill battle. As a retail trader, you're going up against some of the most intelligent businessmen and computerized algorithmic systems in the world. They have more money than you, more experience than you, more resources, more contacts, better software, faster executions, less emotions, and one simple, ruthless agenda, and that's to take your money. So that's what this all boils down to. Everyone is friends on social media, messing around and joking. But at the end of the day, you really have no friends. Everyone is fighting to take each other's money. That's what it comes down to. You're deeply, deeply in the hole before you even begin as a new trader. Therefore, you need to hone in on your advantages and be on a relentless pursuit to utilize them as often and as effectively as you can. So what are those advantages, right? Your main advantage as a retail trader, against computers, institutions, and other traders is discretion. Just as when you're in a casino, your only advantage against the house is your ability to, get up and walk away when you're up. They can't force you to play. That's your prerogative, discretion. Your ability to discern and evaluate your trade at any point in time and make a proper decision to remain in the trade or cut your loss quick instead of sticking around and getting eaten alive. Another way to put that is your ability to manage risk, right? It's the sole thing that will keep you in this game, and it's your cornerstone to success as a trader. If your aim coming into this game is to see immediate success and striving for perfection and turning, a large majority of your trades into winners, then you're going to have a very, very bad experience. Probably about half the time you're going to be incorrect on your trades, and that's fine. You need to accept this. If you get involved in a trade that starts to go against you and your first reaction is to get annoyed and fight it, averaging up or down to try and, trade your way out of it, you're usually going to have a very bad experience. That's going to end poorly for you more times than not. So if that's the habit that you have, please lose it immediately. There are times at a later stage in your trading career when you've got, a more mature understanding of the game and some more money that you can pick and choose your battles and fight sometimes. But as an aspiring new trader just trying to survive and build capital, there's just no room for that. None. So the sooner you realize you have zero control over price action and market movement, the sooner you'll be able to drop the ego and stop fighting and getting stuck in trades. You've got to come to the market every day with the mentality, I am going to trade well today, not I am going to make money today. Okay, you need to be aligned with that frame of mind, supporting I'm going to trade well, I'm going to focus on good entries, and if the market wants to pay me, great. And if not, that's okay too. You can't force the market to pay you, and it can be very unforgiving if you try to make that happen. So never think that your thesis or your due diligence is above price action. Price action is always the king. So that's very important to remember. Something I see all too often is guys coming to me and saying that they trade really well for a period of time, and then they have, this one bad stretch or one bad trade that wipes everything away. They come to me and they say, I have a good amount of winning trades, but my losers are always way bigger than my winners. That's a very common problem. And the thing holding most people back, I would imagine, considering the amount of people that come to me with that, it seems, that I know that was pretty much my main issue. So I assume that's fairly common. Is that something you identify with? As soon as I hear that story, I know exactly how this person operates mentally without even having to see them place a single trade. These traders pretty much trade their P&L instead of trading the chart and the plan. They're far too focused on the money, leading to them being impatient with their winners and far too patient with their losers. It's kind of ironic we have, that the fact that we hold on to our losers out of a fear of losing, isn't it? It sounds pretty stupid when you put it that way, but it's kind of true, right? This stems back just to basic human psychology and the fact that, we don't want to lose. We don't. It's ingrained in our DNA. Nobody wants to lose. Everyone has an ego and thinks that they know more than they do, that they're different. And as soon as a trade goes against us, our first instinct is to take it personally and develop a vendetta mindset moving forward in that trade. We just don't want to accept the loss, right? This is something you'll battle with from your very first trade to your last. Little do most know, and unfortunately usually find out the hard way, is that this approach only leads to losses growing larger. After a string of bad losers, you go on the defensive, and anytime you enter a winning trade after that, you're very quick to take the profits and minimize your gains, right? You breathe a sigh of relief, like, oh, finally a winner, and you just cut it off really quick, just to make sure you're locking in that green trade. And that mindset is the beginning of a long, painful journey of unsuccessful trading and slowly bleeding your account down to nothing. So if that describes you, just know that you're not alone. You're actually very much in the majority, and there's hope for you. You can fix this. So how do you fix it? The way to fix it is quite simple. It's to develop a plan for every trade and do not deviate. If you're trading a small account and trying to grow it, this applies to you the most. You have no room for failure here. You absolutely have to do this. Let me give you an example of one way that I like to do it. So I don't really set targets for my winning trades. I'm a firm believer in paying attention to the volume on the way down and a firm believer in mental trailing stops. I also don't have my unrealized P&L anywhere on my screen. I think it's a distraction and just influences you very negatively for the most part. I don't think there's anything positive that can come out of it. If you're trading with the correct size and the correct plan, there's no reason to have your eyes glued to that unrealized P&L. You find yourself paying attention to that little unrealized number more than you're paying attention to the chart and the price action and the volume and everything else that really matters. You probably got too much size, maybe your account's too small, whatever. There's an issue. If P&L rules your trading, something is not right. So we need to fix that. So trade management is really the key. Let's use an example. I'll just give you one situation of a type of plan that I like to use to kind of maximize a winner. So let's use an example. Stock XYZ is trading at $11.15 a share, and you think you see a trade. Okay, so I put in a top a few minutes ago at 11.25, and it looks to be fading now. So you enter short at 11.15, and maybe you set your stop about 10-15 cents above the high of day. So if it peaked out there at 11.25, maybe your stop is like 11.40 or 11.50. Never set your stops right at the high of day, because that's a popular spot that most others are setting their stops. So should it reach there, it will likely squeeze through there for a minute as stops get triggered and shake out the weak hands before it's going to go in its true intended direction. So use a bit smaller size than you normally would, and give your stop a little more room than usual above or below that key level that you're risking off of, where most would stop out at. I think that's really important, and that's helped me many times. How many times you get squeezed out of a short just to learn a few minutes later that you covered at the top, and it would have ended up working out perfectly if you just waited. You're not unlucky. It doesn't only happen to you. You just weren't thinking ahead of the crowd. You were part of the crowd. Trading your P&L, trading scared like the rest of them. Money or fear should never cause you to close a trade. Hitting your intended predetermined risk level should be the only thing ever stopping you out of a trade. Not, holy crap, I'm down way too much, I need to get out of this trade. That should never happen. So that's the first part. Always set your stops a little above or below the key levels that you're risking off of, depending if you're long or short. And be able to comfortably do this by using a little smaller size than usual to allow for that extra wiggle room financially. So say XYZ blows through the 11.25 high a day. Now we're up trading in the 11.30s, 11.40s area. And it begins to consolidate for a few minutes up here and doesn't come back below shortly after the high of daybreak, then you exit the trade, no questions asked. But you want to give it a chance to break the high of day and come back under. There's no, well, let me see what this thing is going to do. I'll move my stop, from 11.40 to 11.60 just to see what happens. None of that. There's no changing your plan in the middle of the trade. So don't do that. Follow your plan. Do not adjust it, with hope that it will reverse. Stop out, take the paper cut and move on. End of discussion. Okay, so that covers the worst case scenario, the loss side of the trade if you have to stop out. Now let's go over the winning side of the scenario. So assume you get short at 11.15 and the trade starts to work in your favor and it starts to fade. XYZ fades down to $11 now, and you're up about 15 cents or so from your entry. Maybe here you want to lock in half of the profit. There's nothing special about $11 or 15 cents up. That's just the number that I happen to be using here. It's going to change, based on the range and volatility of the stock. But just for the sake of numbers here, I'm just picking random numbers. So you enter at 11.15. It comes down to 11, and maybe you lock in half of your profit. Now with the remaining half left on, we're going to use a mental trailing stop. So right after you lock in half, your new risk level on the rest of that position is automatically moved down to your initial entry, break even. Okay, so we just locked in half at 11. So now we move our stop down to 11.15. That's the new stop, okay? But unlike your first risk level, we want to give it room to try and blow through once. This one is non-negotiable. Nor should there be any wiggle room. If it gets back to 11.15, you stop out of this trade. We want to ensure that we remain profitable on the trade, right? So at this point, if XYZ holds 11 and starts to float back up towards 11.15, we're out immediately to assure that we don't turn this into a losing trade. Let's say it doesn't do that though. It doesn't float back up to 11.15 and we get down to, it's down to $11 a share and then it starts to head lower. Your mental trailing stop should be the exact difference between your initial entry and where you locked in the first half of the position. Right? So we entered XYZ at 11.15 and we locked in half at 11. So that's a 15-cent gain. So that's our mental trailing stop number moving forward. So if XYZ continues down to 10.85, our new risk level is now $11. If it washes out to 10.60, our risk level is 15 cents above that. 10.75 is our new risk level. If it moves a little lower to 10.40, now we're risking off of 10.55, right? You get the idea. And you'll continue to leave this half of the position on until that 15% buffer is breached, where you'll then stop out of the trade for the remaining gains. And again, there's nothing special about 15 cents there. That's just an arbitrary number that I use. You'll have to play with this. Everybody's going to be different. Play with it to make it your own, but that's just a general idea of how the process works. This is an easy way to, first of all, lock in some profit for a green trade immediately. And secondly, it's a way to get the most out of your winners, right? If you truly nailed your entry, a stock can fade for a long time. So you want to put yourself in the best position possible to get the most you can out of it while still being risk conscious. In this particular example, like I said, 15 cents was our buffer, but that number is at your discretion based on the particular stock, the price, the range, the volatility, etc. Like if you're trading a $100 stock or something, you're not going to have a 15-cent buffer, right? Maybe it'll be more like 50 cents or something along those lines. The whole point is so you understand the idea. All right, I'm getting a little long-winded here, so I'll wrap it up. But that's just one example of a type of plan that I would use in my own trading to try and get the most out of it. There's, many other variations of that. You can get creative with it. But the one constant in all of this is that you need to have a plan, a set plan ahead of time, and you need to follow it without fail. I'm sure that's something you've heard often, yeah, I know that, yada, yada. But it truly is the key to achieving consistent success, from where I'm sitting at least. Most people do not do this. Stopping out when planned to keep your losses small and using mental trailing stops on your winners to get the most out of them. That is just the best way to grow an account, in my opinion. Not maxing out margin or trading above your means and hoping to hit some home runs and jump your account up your small account up really quick. That's not going to end well for you. I wish you wouldn't use that approach. So challenge yourself. Say today, I'm going to trade smart. I'm going to create smart, risk-conscious plans for every single trade I take, and I'm going to follow those plans without deviation. No matter what. Write it down and then do it.